Good morning, guys. Today, we're going to discuss to you easy way to understand income and business taxation. Module 6 on domestic and foreign corporation. So, what is domestic and a foreign corporation? A domestic corporation can be a wholly owned Filipino resident having business here in the Philippines. However, it can also be a domestic corporation if there is at least 90% are Filipino and the remaining 10% are invested by a foreigner. Foreign corporation are those owned by foreigner by more than 10% of a foreigner where the business is located here in the Philippines. A domestic corporation are different from each other on the manner of computation. On the domestic corporation, both domestic and foreign corporation, the tax will be computed for both domestic and foreign corporation. Sales are located within and without the Philippines. Sales located without the Philippines. Expenses located without the Philippines. Prior year's excess tax credit in the Philippines, but no on the prior year's excess tax credit MCIT in other countries. Okay. While in foreign corporation, you only need to take a look only within the Philippines. So, sales minus all the expenses only in the Philippines for the foreign corporation. Okay. A corporation, whether domestic or foreign corporation, pay the taxes quarterly through 17 auto form. So, here's the form for the first quarter, meaning to say, from the January to March income, you're going to pay it after 45 days on May 15. For the second quarter, which is April to June, you're going to pay it after 45 days, so it will be August 15. For the third quarter, which is July to September, you're going to pay it after 45 days, so which is November 15. For the fourth quarter, so it covers October to December, you have the option of either paying it on February 15 or waiting until April 15 after the auditing statement. Okay, let's try to compute. So we have problem number 1. Sales in the Philippines is 10 million. Sales in Malaysia is 4 million. Expenses in the Philippines is 4.2 million. Expenses in Malaysia is 32%. So you need to multiply it from the 4 million of Malaysia. Tax credit in the Philippines is 100,000. And tax credit in Malaysia is 273,000. Compute if it is a domestic corporation. So here's the computation. You need to compute both Philippines and Malaysia, except that in the manner of tax credit, you need not to compute the tax credit without the Philippines or in other countries or not in Philippine territory. So you already compute, so you have the grand total of both the Philippines and Malaysia, you add, and then you have this. So you take a look on the income tax. So income tax is computed by means of getting the 30% of the operating income. So operating income, which is 8,520,000 multiplied by 30%, so you have your income tax. And because this is a net income, you need to pay the 2,556,000 to the BIR. So, MCIT only happens when there is a net loss instead of having a net income. Okay. So, the computation of this is called as the income taxation. But, for the value-added tax computation, this one is called as the business tax. Okay? Or the business taxation. So, how to compute the VAT? You need to get the output tax of the sales. So, 14,000 divided by 112 times 12. And then, you also need to get the input tax of the expenses, which is 5,480 divided by 112 times 12. And then, you deduct those two. So, whatever it is, the remaining amount will be the value-added tax. So, here, aside of paying the 2,556,000 of income tax, you also going to pay 857.14 of your value-added tax. Okay, if it is a foreign corporation, what you need to do is only get the business in the Philippines. So here, we have the income tax of 1,740,000 by means of getting the operating income of 5,800,000 multiplied by 30%. So this one is the 30%. So supposedly, this should be submitted to the Bureau of Internal Revenue. Okay, so after deducting the tax credit, you already have your net income, which you can get a share of it and then divide it to the number of stockholders as their dividends. So we're not going again to use the MCIT because there is a net income. If just in case this one is a net loss, then that's the time we're going to use the MCIT. Okay, so this one is the income tax, and this one is the business tax, the value added tax. So again, how to compute this? You need to get the 10 million or the sales divided by 112 times 12, 4,200,000, which is your input tax. So 4,200,000 divided by 112 times 12. So the deduction of these two will be your value added tax, which is 621,428.57. Okay, problem number 2 is compute income tax per quarter if it is a domestic corporation. So again, you need to combine the sales from domestic and the sales from foreign. So for example, so it's 3.5 plus 3M, so it's 6,500,000. For the second quarter is 2,400,000 plus 6M, so it's 8,400,000, and so on and so forth. So you need to get the first quarter computation, the combination of domestic and foreign business. So you need to get the sales expense and then deduct this one in order to get the operating income. So you have 2,970,000, and 30% of it is your income tax. Okay, and then deduct the tax credit in order for you to get the net income. Okay, for the first quarter, you are going to pay the BIR 891,000. So this means to say that you're going to pay it on May 15. Okay, and for the second quarter, after computing the certain financial income statement, you're going you get your income tax of 1,326,000, which should be submitted to BIR on when? August 15. For the third quarter, you have 1,519,548 to be submitted to BIR on November 15. And for the fourth quarter, you need to submit it. Maybe you can submit it on February 15, or you just wait for the payment or after the audited financial statement. So you have the option until April 15. Okay, so this income tax belongs to the income taxation, while the value added tax that should be computed is part of your business tax. So we need to say, aside from paying your income tax, you're also going to pay your value added tax, which is your business tax. So how to compute this one? Again, you have your output tax sales, which is 6,500,000 divided by 112 times 12 in order to get the output tax. And from your input tax, you need to get the expenses divided by 112 times 12 in order to get your value added in order to get your input tax. So you deduct the two in order to get your value added tax. Okay, what if the business is a foreign corporation? Again, it's almost the same, but the problem is you need to get only the domestic business of a foreign corporation. His business that falls only in the Philippines, so it is within the Philippines. That's why we just get the domestic business and put here. So for the first quarter, this business pay 693,000 and going to pay it on May 15. So the scenario is almost the same with the domestic corporation, except that in foreign corporation only need to get the business in the Philippines. Okay? So that's it for the computation. So I'm just hoping you understand our discussion for today. Again, this is Ma'am Ching, and goodbye. Good luck.